All right. A little different with the microphones. Yeah, if you don't have your headphones on already, that'll be how you'll hear us. But yeah, so let's dig in. You know, we've heard a lot about tokenization already, a lot at this conference. So let's jump in. We got 300 billion in stable coins, more than 30 billion RWAs now. So first, just kind of want to get just a quick reaction to the growth of stablecoins in recent months about to hit that 300 billion mark, because that'll be, you know, the cash leg of this on-chain world. So just quickly, maybe Santiago, I heard you talking about stablecoins on a previous panel yesterday, and just kind of the importance there. How does that kind of set the stage for tokenized RWAs more broadly?
Well, look, stablecoins are a killer product. The reality is the entire world wants to hold dollars, and you're just filling that demand. It's borderless. It is regulated now with Genius Act, and so it is a very convenient product. And it's, I've said it time and time again, like even if we stopped innovating and we just kind of focused on stablecoins, it will change consumer finance. It's this idea of programmable money, and so of course we're kind of now in the phase where like, why did this increase so much? And I think you can point to a variety of factors. I'll let some of the other panelists kind of dive into that, but it is, I think, still a tip of the iceberg. We don't need to focus on all the different other type of flavors of RWAs. I was in a panel yesterday, like I am kind of a bit skeptical that we can bring on more bespoke assets that you stitch together kind of off-chain, on-chain. I think we still haven't figured that out, but stablecoins in their own right are this seventh wonder of the world, which is programmable money.
I think they call it the quintessential killer app for crypto, and also the quintessential RWA. So totally agree. It seems like definitely the regulatory and macro environment has been very conducive over the past year. And so especially with Genius passing, it sounds like everyone and their mom is issuing their own stablecoin. I think like any company that has embedded distribution already is thinking about launching their own stablecoin. Obviously, there's a lot of questions around interoperability and use cases and applications, but it is something that's very much top of mind, not only for crypto natives, but also traditional Web 2 companies, institutions, enterprises. And the way that I look at stablecoins is very much kind of like the top of the funnel for a lot of different kind of incremental blockchain-enabled products and services. So access to dollars, to Santi's point, is like the first kind of entry. But then from there, a lot of companies are thinking about digital savings accounts being enabled through stablecoins, being able to earn rewards or yield on those stable coins through money market funds, through DeFi integrations, and then finally the ability to actually spend down or against those stable coins through stablecoin-backed card products. And so this kind of order of operations is what a lot of different institutions and enterprises are thinking through.
And of course, there is a huge retail side to this, but there's also the B2B aspects. And so when you think about the evolution of, you know, structured credit products and those being tokenized, ultimately use of stablecoins as a cash flow product and taking that tokenized programmable money and embedding it in a security, that's an incredible use case. And I think that a lot of the institutional adoption we'll be seeing in the years to come will be really utilizing stablecoins or tokenized deposits in a way that facilitates how most cash flows exist in products in TradFi throughout the world.
Yeah, and so outside of stablecoins, that number, 33 billion in RWAs, I believe half of that is in private credit. We've seen tokenized money market funds and more developments on the tokenized equities side. Now, we'd love to kind of just hear some of the areas of tokenization that you guys maybe have the highest conviction in, you know, before we start digging into use cases and adoption.
Yeah, I think tokenization is taking the path of least resistance. And what I mean by that is you start with the most liquid stuff, which is the cash. We have a pretty big effort there, right? 300 billion. It's the use case that we should be most proud in crypto that kind of came out of everything that we're doing here. I think next is tokenizing T-bills, which that also happens. Like indirectly, the fiat-backed stablecoins are also a form of tokenized T-bills, although the yield stays with the issuer. Now we have this second wave of T-bills where tokenization, where the yield is passed on to the the holders. And then from there on, I think we're going to see other types of debt instruments, perhaps other types of sovereign bonds and corporate bonds and private credit as well. And then we got to a point where we kind of move over to the next part, which is tokenized securities, primarily equities. Now, I think we're still very early, and I think the way we're approaching tokenized equities is probably not the form that will be long term. In fact, it's a wrapped version. In a way, it's also a debt instrument because it's an IOU that gives you the potential to redeem a security or a unit of stock later on, but it's not actually the underlying thing. So we've seen some indication from a couple of projects that are actually building native tokenization of equities. And I think that's exciting. I think that's very interesting. If we get the regulator on board as well, just like we did with the stablecoins, it will open up a massive wave of innovation, not the least that we can actually start trading these 24/7 instant settlement. Unlike what we currently have here, we still rely on the kind of opening markets to mint and redeem these instruments. And also when the markets are closed, the spreads widen up a lot, and it doesn't really solve the primary issue that we started off with.
Equities really are a great example of where you can really drive into the why tokenize, the value proposition that's being presented both to the end investors, but also to the issuers or the tokenizing agents. Within Hedera, we've looked at projects like Swarm Markets. They are innovating on the tokenization of equity side to ensure that the interconnectivity to other pools of capital remain. So you have DeFi-enabled, compliant tokenization of large-scale U.S. equities, but ensuring that trade execution can also filter through to traditional markets where the liquidity is far greater. So it's creating the bridge structures and the interoperability to traditional markets. And I think that's one of the big themes within Hedera that we look at around how we bring on the next wave of institutional adoption. It's ensuring that there's clear value proposition and that the connectivity is there both in terms of interoperability across networks, but then interoperability to legacy systems, which is key. And that can come in terms of cash and in tokenized securities.
I think zooming out, to your point around what are the clear first next steps of what we want to tokenize and what we shouldn't be tokenizing, because when you go 24/7 365 market structure may or may not be there when you want to trade Friday night. And go talk to a high yield bond trader, he'll tell you sometimes that market's dry. And so there are inefficiencies, there are the technology, the infra, the APIs maybe get bricked when there's that load surge. And so we got to make sure that, every iteration, every event like this allows us to stress test. But I'll give you one example. There's DeFi is a marginal improvement to the current paradigm of financial system in the sense that even if you have these issues that we know in crypto, like the Oracle pricing model, market structure, and congestion and whatnot, you're moving from an opaque, antiquated system, and you're moving to a transparent system. So if you want to have a digital representation of collateral, you might say, wait a minute, but how do you verify that? And I think we got to remember, anyone that's been in finance and the global financial crisis, you don't understand your counterparty risk. You're relying on a regulator or an auditor to not do that in a continuous way. But you have you call up your people, hey, are you guys okay? Well, yeah, of course we're okay. Steady lads, we're deploying more capital kind of thing. In crypto, at least, you have this ability. Imagine if you have all of this collateral represented as an NFT and you have some information about it. It at least prevents issuers off chain to double pledge that collateral, which happens time and time again. And so you're not going to fix everything. It's not a perfect, but at least it moves us from a more not a transparent system to a transparent system. And it mitigates a lot of the issues that we continue to see in TradFi, which is just that opacity and off-chain and off-balance sheet items. So it's just important to kind of remember, if we just do that, I think it's a very marginal improvement, meaningful improvement to avoid a lot of catastrophes in TradFi.
Yeah, and I want to get into private credit, but while we're talking about equities, we've seen NASDAQ file to tokenize securities on their exchange. We've seen Kraken's X stocks and Robinhood stock tokens, which offer exposure to the price of stocks, but not shareholder rights or things like that. So just kind of curious of how you kind of see tokenized equities evolving and the regulation that we're going to need to see to kind of bring this to the next level and have these, yeah.
So, from my perspective, it's just indicative of the way that institutions are moving from, their siloed independent ledgers or account structures to a wallet-based infrastructure. It's coming in multiple different flavors. Of course, you're seeing the Robin Hoods of the world that are saying, "All right, we're going to distribute, through tokenized stocks to the retail population." You're seeing it on more of the settlement side, where institutional ledgers are now really in an experimental phase of representing their assets in wallet infrastructure, and I only expect that to accelerate.
One thing I would add in the NASDAQ kind of development is a good example of that is I think over time we spent a lot of time kind of cultivating high quality tokenized asset supply in the ecosystem. And now, at least from an Avalanche standpoint, we're very focused on the demand side. And that could be integrating with DeFi to the extent possible. But really, and I think the unlock is integrating with traditional distribution channels. So to the extent like you'll ever be able to access tokenized equities on NASDAQ, like that's huge because you're meeting investors, people, customers where they're at. And so from a mass adoption standpoint, and Santi knows this, we're very much aligned in this in terms of just really kind of abstracting away the tech and meeting investors and consumers and users where they are. That I feel like is going to be a really big unlock for crypto writ large, but also specifically for RWAs.
I mean, it's going to move from we're tokenizing these particular assets here and there to whole platforms are going to say we're tokenizing all equities available through our platform, or we're tokenizing all the debt products. It's going to be much more of a solid foundational level.
And to the point where people won't even know or care that it's tokenized, ideally.
Well, the thing about crypto is like the uber bull case of tokenization is crypto is very good to find price discovery on a whole set of illiquid assets, and that's sort of the innovation of like an AMM, like the bot, that curve, right, where there's that continuum. You always find a price, and there's always kind of the ability to settle that. And I think that is perhaps offers a glimpse into bringing more liquidity in secondary markets that in traditional finance just are really hard, and you combine stuff we've talked about like stable coins, the ability to settle and go to a stable unit of account on chain in a digital manner is instrumental. Like an example of that's Polymarket. You had Augur, which was kind of one of the early instantiations of prediction markets. It's really hard to spin up a prediction market if you don't have a unit of account, because it sucks that you win the bet or you win the market and then wait a minute, the collateral goes like you actually lose money because ETH goes down 80%. So, but now you're in a very different state, right? So I think like the combination of these kind of money blocks and Legos where you have stable coins to settle into, you have like an AMM construct like Uniswap kind of pioneered, which is you have continuous price discovery. And so I think it offers a glimpse into 24/7, 365 markets, where if you want to open up the US, the rest of the world population that doesn't have access to Tesla stock on a Sunday, you could do that, right? And you can have kind of orderly markets.
Well, it's the value proposition, and access absolutely is one component of the value proposition. Another one is the programmability of it. So being here in London, there's a firm, Archax, which is a fantastic tokenization platform. They've been working with a number of different chains, including Hedera, and they are pushing the envelope on how you can programize assets. So taking various tokens and pooling them together, representing them in a singular asset that can be used as a collateral form, can be transferable. So I think gone will be the days very soon where you have your mutual fund or 401k, and in order to move that from one platform to another, you have to liquidate those assets, divest, get a check, have that check mailed to you, deposit into a new institution. You should be able to and will be able to move these customized risk portfolios and really lean into the value proposition of an asset that can be a new collateral form once tokenized.
Yeah, and in preparing for this panel, I know Morgan and Santiago, you guys talked about having conviction in private credit as well. Would just be curious of the infrastructure gaps you're seeing in private credit, and then maybe some of the use cases that you're testing out there.
I'm happy to kick it off. So I think private credit's a really interesting use case in the context of leveraging this tech being tokenization, stablecoins, blockchains. in that today the private credit industry, specifically like asset-backed finance, is dominated by, say, the top 15, 20 private credit managers. And part of that is because, a huge percentage of their firm is middle and back office, who are actually processing all of the incoming loan requests, reconciling incoming loan requests against credit facilities that they give to various originators, and then actually funding those loan requests, which takes, at best a week to kind of wrangle all the LPs and do capital calls and actually facilitate that funding. And I think leveraging this tech, being again blockchain, programmatic credit facilities, and stablecoins, allows emerging managers, family offices, new funds to be able to actually participate in the space. And it's not a spin, but it's like an interesting conception, the concept of like democratization of finance. Usually it talks about like retail, being able to kind of access finance, but it's really allowing institutions and lowering the barriers for institutions to actually participate and even compete in the private credit space. And it's something that we're kind of very focused on and convicted in the context of bringing programmatic money or better money to very traditional Web 2 fintech originators and saying, the value prop is not, do you want to use this or you should use this better tech, but it's, do you want better money? And I mean, they're not going to say no, or they haven't said no so far.
Right.
Yeah, I think like HELOCs are probably a good example. There's a company called Figure Markets, and look, again, they've found a wedge in the origination side, in the settlement approval times, and that go study that workflow. And I think the reality is when you're moving money in the traditional way, it's T+5, and the reconciliation of the back office, and like any bank out there, if you got understands the biggest driver of costs in a bank is just back office and compliance. And I think when you migrate some or all of that workflow to a smart contract with a very narrow defined set of logic that has been formally verified, and you have those guarantees that if X parameters are met, that logic will be executed, and you have atomic execution, and you can inspect the collateral, you can inspect all these different things. You start seeing a world where money just moves at the speed of light and is much more efficient, capturing yield if it's sitting idly, and then you can draw down that vault. So that's where we're going. I mean, it will take some time, but you see these glimpses in instances like Figure that gives us confidence that we're going to go much, much higher.
Within Hedera, we're really focused on those applications that lean into the scalability of the blockchain itself. And so highly scalable institutional adoption from a B2B side is really the area of focus. Now, today, where we are, we're seeing the infancy of this, right? We're seeing from private markets the tokenization of real estate. So Red Swan, which is a broker-dealer in the U.S., recently tokenized the first building of the New York skyline. A hotel on Rivington. And so you see applications like that are driving, smaller scale one-off deals. But I think that the proof of concepts in many ways for the broad scale adoption of this technology, you're seeing it in other avenues. Zonix, which is a tokenization platform, recently tokenized One World Petroleum, so oil and gas fields. And so you're seeing micro products that are coming to market. But the technology is proving itself with this for larger scale adoption.
I think private credit is actually a very interesting example of keeping it low, and there's a lot of noise around tokenized equities, but actually being a lot bigger than the equities that we're seeing. So Figure is that example. They've been just building, and they've grown their TVL on chain quite significantly. It's actually latest numbers say at least a couple of times higher than what we've seen in equities. And I do think bringing on more sources of yield, and private credit is one, will only enhance what we have in DeFi. In fact, the more we have of that, the more interesting yield-bearing instruments we can build around. And in DeFi, one thing that we really like is composability.
Yeah. And Morgan, just kind of wanted to double click on, as you guys think about designing pilots to test these use cases, what goes into that decision? How are you just kind of thinking about the best ways to test the utility? Because obviously utility is going to be how this space takes off.
I love that you said double click.
Yeah.
It's a consulting term. So
I've picked that up somewhere. Yeah.
Great.
All these conferences.
I think that for us, we always want to talk to the business side of the partner that we're working with. And especially when we're talking to TradFi, a lot of the times we're talking to the digital asset teams, which is great. But we're moving to a point where they are involving business sponsors and people from the business to understand and validate and confirm, like, yes, this actually is a pain point that I'm experiencing, and this is a business-related outcome that will kind of help drive things forward, whether from a risk and control standpoint or from a P&L standpoint. And so whether it's working with banks or even fintech originators, sitting down with them and kind of transcribing the capability into terms that they would understand that are palatable for them, that makes a very big difference. Because again, it kind of goes back to the better tech versus better money question. It's like, what is the so what? What is the implication of this thing that we're talking about? And to verify that that is the case. And it's been really cool to kind of frankly sit in some of those conversations with the head of capital markets from so-and-so firm, and for them to talk about how the process works today and how it could be totally kind of revamped. They don't have to spend half a day every week kind of reconciling things over Excel, or they can kind of draw down from a facility on a daily basis instead of a weekly basis. And those are impactful kind of outcomes to their bottom line. And so really kind of validating that, I think, is a kind of a key part to any process, frankly, when it comes to RWAs or on-chain finance.
Yeah, and Santiago, you've been on a lot of panels, so I've been listening to you the last couple of days. But yeah, you've been talking about integrating blockchain tech into day-to-day operations. Morgan kind of mentions it there. It seems the benefits of it are obvious and have been stated. What maybe are some of the hurdles that are still there for businesses looking to do this?
Yeah, I mean, it dovetails really nicely what Morgan said. The obvious skeptic in the room might say, why hasn't this been adopted before? Like, this technology has been around for quite a bit of time. And I think, I started Inversion in November of last year when I saw a path of a very different regulatory regime and administration that would regulate sensibly these assets, because the technology and the infrastructure is there. And so I think like that was a key blocker. We're not there yet. I think there are sensible pieces of legislation that have been put forth, but I think DeFi as a whole, we still need to have more regulation there. I'm excited because I think the U.S. will set the tone, right, for the rest of the world. Maybe Europe for a bit, but like the rest of the world really looks at the U.S. And so that's really, but it might take time, right? The other roadblock is at Inversion, we take this approach of like, we want to own the sandwich, right? We want to own the user aggregation layer. We're buying companies where we can inject them with this like replace old antiquated infrastructure, bring a workflow like you described, Morgan, and make that business just structurally more efficient. And then I think like every chain out there says that they are the best in TPS, in security, and a lot across all these vectors. The reality is until we stress test this technology, we're really not going to know. And so I think I'm excited for that because we have 30 to 60 million active users in crypto today as a whole. What happens when we bring 1 billion users or 500 million? And I think it's just really understanding that sometimes we have a preference for partnering with DeFi protocols, stablecoin folks. We're an Avalanche L1, so out of the box technology is very useful to us because it allows us to focus on what we do best. But, there's some tooling that will be required as we build, and you'll identify gaps in the particular workflow. So sort of like I don't know, in the same way that I think a lot of people didn't really imagine what the first, second, or third generation of the iPhone was going to do. But we're talking about money, and that consumer behavior doesn't really change that much. There's certain things that, as I said earlier, if we just stick to stablecoins and yield, it is a massive opportunity to change consumer finance in its own right. But, like every good technology, like no one really imagined that the iPhone was going to allow you to order food and watch videos and do all of these things. We just got to be there, prepared, listening to the customer, and building and iterating to serve what they want best.
Right.
I'm not convinced that the value proposition is immediately and readily apparent to those that may be outside of this room. And so as an industry, I think it is our responsibility to continue to demonstrate that. And that comes in the form of net new revenues for businesses. It comes in the form of cost reductions through automation. It comes in terms of expanding the client population that can invest in a variety of different products. And so, every conversation is unique based off of the use cases, but I'm sure Morgan has experienced this as well. The reality is, with the change in the regulation, with the U.S. leading the adoption phase we find ourselves in now, banks and other financial institutions are far more engaged than they have been in the past. And that's really what's going to be the significant change, where we get to be able to stress test these networks and have the scalability, because the size of the tokenization is really insignificant relative to broader financial markets.
I will say, just on this point, we always at Inversion have this challenge of lead with business logic, not ideology. And so I can tell you, we've looked at telco businesses, and we go talk to the head analyst at a major investment bank about the thesis that we have. And it's like, can you walk in our room? And can you talk about this technology with ever mentioning some of the lingo that we are using here freely? And if that executive, that board, the board or that analyst understands the business logic, then that's how you know this technology. I'll give you an example. In the telco space, we are evaluating the ability to offload. I'm not going to go into what that all means, but I can tell you I've talked to former CEOs of some of the largest telcos in the world to validate this thesis. And I would describe Helium in a way without mentioning that it was crypto. And they would say, oh, yeah, we do that. We do that. We have our hotspots in a highly dense area like London. We have our own hotspots. And he said, okay, so the only difference between what you have deployed to allow you to make your business better and what exists in this new world called decentralized finance and decentralized physical infrastructure networks is that one is open and the other one is permission network. And then you kind of go into the nuances, and he's like, oh, that's really interesting. We actually tried doing that before, but we couldn't solve the reliability or the uptime of the hotspots. And then I think you get into a more nuanced discussion around why is this possible today? And then you get them to agree on that. And then the final question is this actually possible with regulation? You say, yes.
Right. Yeah, and we brought up regulation, so obviously a lot of progress there in the last year, and with Genius Act, with market structure legislation still kind of pending in the U.S., maybe will pass next year. Rebecca Reddick said on stage yesterday that's kind of her thought. Curious of what you guys are waiting for on the regulatory front to further unlock utility, and maybe some of the conversations that you're having with regulators, or what's top of mind for you as we look for that next.
I mean, I think it remains to be seen if we'll see changes in securities laws, because I think that has direct implications for, accredited investor accreditation laws and kind of what they're able to access, whether an asset's tokenized or not. Same thing with tokenized equities. I mean, that would also be obviously a very big change, but it's interesting to see a lot of the consideration for change in these historically antiquated laws that potentially now are kind of potentially keeping pace with the pace of innovation and technology. So TBD in terms of what happens there. I think to the point that was said earlier, even where we're at today versus where we were at a year ago, it's been like a total 180 in terms of the conversations that we've been having, especially with banks and FMIs about leveraging public blockchain infrastructure. Now they're like, okay, what do we use public blockchain for? Like, how can we engage, and what does that look like? And so, I do think that we'll see more and more regulated banks, and asset managers have been here for a bit, but banks and FMIs kind of leveraging more kind of open source, public permissionless networks. I still do think that there's a world for purpose-built L1s for very particular purposes and applications. But it's been kind of great to see, again, more banks and even neobanks. I think we'll start to see really a sense of urgency among the banks, and seeing some of them maybe get some FOMO when we see the neobanks and challengers really kind of getting involved and actually seeing net business outcomes and benefits, and potentially eventually kind of taking some market share from banks. I think that's really where we'll start seeing banks willing to invest the resources to upgrade and kind of override their tech debt. I mean, they have years and years of tech debt, right? But I think we'll get there.
This is sort of the question no one wants to go first. But look, the reality is, a lot of people ask, what happens if after this administration? Can we peel it back? And the reality is, we're past that, simply because Wall Street can now make money off of this industry. I mean, you have a very clear rationale and impetus from the Blackrocks of the world that, look, the Bitcoin ETF has been the most profitable, widely adopted ETF for BlackRock. And so I think you now have the ability for large institutions to make money off of this industry, and that matters a lot. And again, it's sort of like Uber. Uber was super disruptive for the taxi industry, and they faced a ton of resistance in every single market that they went. You just have to sort of believe that if you're delivering extreme value to the end user in the same way that Uber did, you will prevail. Full stop. However, regulators historically have said, crypto, point to me, what is the actual value of this technology beyond this speculation and casino that you've architected to go 50 times levered long and get liquidated? And that's the problem that we face ourselves in industry, which is that we will no longer be able to blame a regulator, a market maker, an exchange for the fact that this technology did not get adopted. It's ready. We can deploy it faster. That's sort of the only reason why I'm starting Inversion and going to accelerate that, because if in 5 years we don't have real GDP coming on chain through tokenization, through serving end users, not just speculative activity of meme coins, which, it's okay, but we can do far more than that. If we don't deliver that, we're going to find ourselves in a tough problem as an industry and saying, okay, what's a reason why we're sitting here in this room talking about this whole technology?
I wouldn't say that there's specific regulation that I'm looking to see, this is going to pass and this is going to unlock, a big change, a step change function. I was speaking with the chairman of the SEC just weeks ago, and the reality is that the guidance that is being provided from both the executive and the regulators across the world is enabling financial institutions to engage in the way that they weren't previously. So it's really a risk reduction that is occurring, and then it's how well does the technology fit their specific needs.
Yeah, I think thinking from first principles, I actually fully agree with what Santi said, which is we finally have a convergence between TradFi being able to make a lot of money, like BlackRock CEO saying everything that can be tokenized will be tokenized, kind of great indication of the future we're going into. But also the fact that the U.S. government, I think, is seeing this as a massive strategic win, where you have this new nascent industry, which is the fastest growing buyer of U.S. government debt. And this is really at the core of it, because while some other, less friendly jurisdictions and countries are starting to de-dollarize, you suddenly have a massive borderless industry that is dollarizing at the fastest clip ever. And I think it just makes a lot of sense for whoever is in the administration to actually not just continue this, but foster it and see it grow. It makes a lot of sense from first principles to do it.
Well, stablecoins are that first adoption tool. It's very easy to adopt a stablecoin. I would expect that as U.S. dollarization continues to be pushed due to stablecoins, that there is the counter to that, where more and more governments require the payments to be in stablecoins of their native currencies. Now, the payment industry as a whole is still just a fraction of the use of stablecoins today. I mean, the real use cases of stablecoins relate to onboarding to various exchanges and arbitrages. It's not the payment rails that we see on legacy systems, but I think that those are really being developed. And that's what gets me really excited when you see supply chain invoice factoring that's being enabled through stablecoin payments across borders, B2B. You can cut down, the period from payment from 120 days down to a programmatic, payment versus delivery type of function. And that can only really be done with this technology. It's really difficult and very, very costly to do that on legacy rails. So I think the more that we can expand the use of stablecoins, regardless of whether those are dollar denominated or others, the more the value proposition for non-crypto related use case will materialize.
let's not forget, like, we at Inversion have a thesis that stablecoin adoption really happens outside the US or places like London, because here you have Revolut, you have PayPal, you go to a place like Mexico, it's very cash-based. People don't have access to credit. And it's a cash-based economy. So why would the regulator, to your point around, we often get asked this question, why would the regulator in a particular place like Mexico want that economy to be dollarized? Or allow their end user to have dollars in the bank account? Because then that poses, to your point around first principle as well, then that sort of destabilizes that local currency. And then you go talk to a regulator and say, well, you sort of have to, the cat's out of the bag, but you do prefer to digitize the economy. Because if you digitize the economy, you can monitor economic activity, and then you can, tax it. And so the informal economy in a lot of these places, most of the developing world is very cash-based. And then once you have it in a digital manner, then you can start thinking about, okay, maybe we'll incentivize people to convert to our local, the peso stablecoin. And I think that's a lot, there is receptivity. So it's like, what is the better outcome? And I think it's sort of like in this new paradigm that you cannot stop. You would rather have a digital economy, and that's a better place. And I think governments around the world are starting to realize. I don't know if you guys would agree with that.
Yeah, I agree. I think like it's the U.S. and the kind of the dollar leads the way, but everyone will have to follow because of the reasons that you mentioned. I think it's just a matter of time, but everything is set in motion, and I don't think there's a way to go back, to be honest.
Yeah. So with that stage set, as you guys mentioned, no longer the regulatory excuse. There's no longer as much of a lack of awareness of this technology. I think before the panel, Santiago, you talked about a 3 to 5 year kind of execution window for making tokenization table stakes. Curious of what you think table stakes looks like in the tokenization lens, and why you kind of picked that 3 to 5 year timeline window of.
Again, this is why I woke up one day and said, God, I'm tired of sitting behind a screen or coming to these panels and pontificating about this goddamn technology. It's good. We use it. But someone has to deploy it at scale. And why, I don't ascribe to this idea that we need to take another 12 years. I've been in this industry since 2012. At some point, you say, the tech is ready. The regulation is there. And so let's accelerate that. Let's actually muscle our way to go-to-market and development. So what does that look like? I don't know if 3 to 5 years. Can we do it sooner? My North Star is, can crypto be a relatable piece of technology for people without necessarily them understanding that they're using crypto? Because infrastructure is invisible. It should be invisible. So our North Star Inversion is, let's make all of this infrastructure invisible such that the consumer may not understand, likely will never understand how this technology works, but they will feel the impact. And I think that is the North Star. That is the standard that we need to hold ourselves as an industry is, are we delivering real value to the end user that will facilitate all of the conversations we have with regulators? You can go in and talk to them and say, gosh, look at HELOCs and look at how that's been a better process, or look at, there's going to be the person that wins the most with this technology is the end consumer. And we just need to be playing a long-term game of delivering extreme value to the end user. If we do that really well, and we kind of focus less on the near-term cash opportunity of maximal extractable casino, I think we would have done a really good job. And at Inversion, again, building distribution is very hard. Convincing people to set up a wallet is hard. Now, thankfully, there's been billions and billions of dollars of venture funds that have done that. But I think now we got to invert the playbook, and we say, okay, let's acquire a real business, and let's just kind of Trojan horse our way into mainstream adoption. And I think we'll do that.
I would take the well under 5 year, because I don't think that we are just in a consumer finance related focus. I think that there is a huge wave of B2B applications that are coming, and they have been, we're in a, call it a 2-year window where there is the adoption of the technology, the stress testing, the deployments on various chains, and then there will be enablement of broad scale applications. And I think that's when it becomes abstracted from the user and is facilitated by institutions that already have established customer bases. Then you won't have the need for the direct engagement from a retail perspective. You'll be able to execute utilizing this technology through your existing infrastructure providers. You pick your bank, you pick your financial service provider.
Yeah, I'm looking forward to, in 3 to 5 years, not necessarily having panels on tokenization, but really talking about consumer lending and other use cases, loyalty and rewards programs, like really kind of digging into vertical specific topics and having various executives talking about like how it helps their business, and going beyond talking about this is a blockchain company, but this is just a company that happens to use blockchain. So very much looking forward to that.
Yeah, we have a few more seconds, Alex, if you want.
Yeah, I think we're at an inflection point. The Cambrian explosion is just around the corner. I give it like maybe 2 years. Yeah, looking forward to it.
Great. Well, we'll end it there. Really appreciate the time, everyone, and thanks all for being here.